Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 2 of Mastering Income Statement Analysis, a guide for better financial insights. Using common size analysis provides clarity on where a company stands. It highlights strengths and weaknesses in cost management and profitability. For instance, if a company's operating expenses are significantly higher than the industry average, that could prompt further investigation. Both trend analysis and common size analysis are valuable tools. They provide insights that can lead to better strategic decisions, whether you're assessing a potential investment or managing your own business. Understanding these techniques can give you a clearer picture of what the numbers really mean. Key performance indicators, KPIs, from income statements. When analyzing income statements, identifying specific key performance indicators, KPIs, can provide valuable insights into a company's financial health. These KPIs help stakeholders assess profitability, efficiency, and overall performance. Let's explore 3 critical KPIs derived from income statements. Gross margin. Define gross margin and its relevance. Gross margin is a key metric that shows the percentage of revenue remaining after subtracting the cost of goods sold, COGS. It's calculated using this formula. Text, gross margin, equals, frac, text, revenue. Text, COGS, text, revenue, times 100. This margin reflects how well a company produces and sells its products. A higher gross margin indicates that the company retains more revenue for operating expenses and profit. This metric helps assess pricing strategies and production efficiency. For example, if a company has a gross margin of 40%, it means 40 cents of every dollar in sales is available to cover other costs and contribute to profit. It's a straightforward way to gauge a company's core profitability. Operating margin. Explain operating margin and its implications for business efficiency. Operating margin measures a company's profitability from its core business operations. It provides insights into how efficiently a company manages its operational expenses. The formula for operating margin is text operating margin equals frac text operating income text revenue times 100. Operating income is calculated by subtracting operating expenses, like salaries and rent, from gross profit. A higher operating margin indicates that a company is better at converting sales into actual profit, minimizing costs while maximizing returns. For instance, an operating margin of 25% means that 25 cents of every sales dollar is profit after covering operational expenses. This figure is essential for understanding a company's efficiency. Stakeholders use this metric to identify areas for cost reduction or operational improvement. Net profit margin. Discuss net profit margin and its importance for stakeholders. Net profit margin reveals the actual profitability of a company after all expenses, taxes, and interest are deducted from total revenue. It's calculated like this. Text net profit margin equals frac text net income text revenue times 100. This margin is crucial for stakeholders as it reflects the overall financial health of a business. A higher net profit margin indicates that a company is retaining more of its revenue as profit. For example, if a company's net profit margin is 15%, it retains 15 cents of every dollar earned after accounting for all costs. Investors closely watch this indicator to assess a company's ability to generate profit from sales. Consistently high net profit margins can lead to increased shareholder value and attract potential investors. Common mistakes in income statement analysis. When analyzing an income statement, it's easy to overlook certain aspects that can skew your interpretation. Common mistakes can lead to misguided decisions and a misunderstanding of a company's financial health. Here are 2 frequent errors to be aware of. Ignoring non-recurring items. Many analysts fail to account for non-recurring items, which can distort the true financial picture. Non-recurring items include one-time gains or losses that aren't expected to happen regularly. Examples are sale of assets. If a company sells a building, the profit may inflate the net income for that period. Legal settlements. A one-time legal win can create a substantial profit, but it won't recur. Ignoring these items can lead to inflated expectations for future performance. Imagine you're evaluating a company based on a single strong year that included an asset sale. If you don't recognize that this income won't repeat, you might invest thinking the company is on a sustainable growth path. However, once that spike disappears, so does the perceived financial strength. To avoid this pitfall, make it a habit to isolate non-recurring items when analyzing net income. Look through the notes and disclosures in the financial statements for clarity. Overlooking context of the industry. Each industry has unique characteristics that impact income statement interpretation. Failing to consider these nuances can misguide your analysis. Here's why context matters. Revenue streams. Different industries have varying revenue models. A subscription service will have steady revenue, while a retail store might have seasonal fluctuations. Cost structures. Some sectors, like manufacturing, have high fixed costs, while service industries may have lower fixed costs. Understanding these structures helps set realistic benchmarks. Economic factors. Economic conditions can affect an entire industry. For instance, during a recession, consumer spending typically declines, impacting revenues across many businesses. Without this context, comparisons may be misleading. Evaluating a tech company's margins against a grocery store won't yield useful insights. Always compare companies within the same industry for a more accurate analysis. Understanding these common mistakes can sharpen your income statement analysis skills and lead to better financial decisions. Avoiding these pitfalls not only clarifies your view but also enhances your overall investment strategy. Conclusion and best practices. Income statement analysis is essential for understanding a company's financial performance. By digging into the numbers, you gain clarity on profitability, efficiency, and overall health. It's not just about crunching numbers, it's about making informed decisions that can impact your financial future. Importance of thorough income statement analysis. A well-executed income statement analysis provides several benefits, identifies trends, spotting patterns over time helps you anticipate future performance. Informs investments. Understanding financial health guides smart investment choices. Highlights operational efficiency. Analyzing margins reveals how well a company controls costs. Missed insights from income statements can lead to poor decisions. To avoid this, dive deep into each component of the statement. Best practices for analyzing income statements. Look beyond net income. While net income is important, analyze gross and operating margins for a complete picture. These metrics show how efficiently a company operates. Context is key. Always consider industry benchmarks and economic conditions. Comparing companies within the same sector provides more meaningful insights. Adjust for non-recurring items. Separate one-time gains or losses from core business operations. This adjustment reveals true performance. Use ratios wisely. Key metrics like gross margin, operating margin, and net profit margin offer quick insights. Keep an eye on these for ongoing performance checks. Review trends over time. Analyzing multiple periods can reveal significant patterns. Are revenues growing? Are expenses stable? These trends matter. Stay updated on accounting standards. Changes in accounting practices can affect how revenue and expenses are reported. Stay informed to fully understand financial statements. By adhering to these best practices, you enhance your analysis. Strong analysis leads to better financial decisions, whether for investment or business management. Keep exploring the details in income statements for a deeper understanding of financial health. Conclusion. Analyzing income statements is a powerful tool for understanding financial performance. Spotting trends, assessing profitability, and identifying operational efficiency are crucial steps in making informed decisions. Use the insights shared here to carefully evaluate your financial situation or consider potential investments. Stay curious. How will you apply these techniques to your financial analysis moving forward? Your knowledge can open doors to better financial health and smart decisions. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.